So good morning to everyone. Today we're going to talk about efficiency of financial markets, right? EMH, or financial market efficiency. Efficient market hypothesis. That's what EMH stands for. Efficient market hypothesis. EMH. So when we talk about financial markets, now we've come to nearly the end of the course, right? And we spoke about stocks and bonds and different types of financial instruments and pricing, even derivatives, right? All of these ultimately are priced by demand and supply. You look at what the proper pricing will be, but finally, everything is priced by demand and supply, right? And when you look at demand and supply, and you look at the correct pricing for an instrument, you have to understand that a lot of the pricing includes expectations. Expectations mean what we expect will happen due to certain events as we go forward. Okay, so for a company, due to certain things that are happening, what we think will happen or how that company will be impacted determines our pricing, determines our future expectation of cash flows, and therefore the present value that we will pay for that instrument today. So, for example, if exchange rate is depreciating and we expect it to keep on depreciating, how will next quarter's profitability be? If for example, a company is now when John Case was doing its project, there was a lot of uncertainty surrounding whether it was going to get the casino project, not going to get the casino project. And every time there was an announcement surrounding the fact that the casino project was not there, prices came down, and then prices went up when there was an announcement surrounding the fact that casino project will be there, right? So there were a lot of expectations that were built in. Prices have gone up, prices have come down, prices have gone up again, right? But the casino is still not operational. There's a lot of movements in John Case prices because of something that's going to happen in the future. Because of the expectation of some event that's going to occur in the future, we're seeing a lot of price movements that are happening today. Because our expectation of what is going to happen impact our future cash flows, impact what we think will be the profitability of the company, the cash flows that will surround it, and therefore how we price it today. But do you also see still John Case has not started this casino operation. Cinema Life is yet to commence officially, but the profits of that project has been incorporated into market prices. And market prices have moved up because of expected profitability from certain things happening because of that project. So so that's something in the future that has not even happened yet, but we have priced in the impacts of what, when it happens, how profitability will be. So this is what we talk about in terms of the roles of expectations. Expectations impact everything that we do. If we feel that central bank is going to give a interest rate cut, for example, interest rates are not going to, people are not going to wait till the day the central bank announces the cut. There are going to be impacts on interest rates today. If you think that next auction interest rates are going to come down or are going to go up today, right? Meaning Friday or Monday, before the auction, before the actual event happens, interest rates will change, and therefore bond prices will change, bill prices will change, and everything else, the pricing will change. That's what we call expectations. It impacts our understanding about the market. When we think something is going to happen with inflation and how that's going to play on interest rates, again, it changes everything about stock pricing, about bond pricing, about derivative pricing. It changes everything. It changes the pricing, and therefore we act on that information, and either the prices will go up or the prices will come down based on the information. So efficient market hypothesis is a way for us to understand how these expectations really impact prices. Is efficient market hypothesis, does it work in real life? Generally, what we say is yes, to an extent it does. The basics work on EMH, right? The basics work on EMH. Every single movement that happens cannot be explained by EMH. Certainly, if there is efficient market hypothesis, you will not see certain things that are happening. For example, stock market bubbles, real estate housing prices bubbles, overreactions, underreactions, excessive market volatility. Certain things will not happen if efficient markets were true. But it is a good base to start building, because it is certainly there is evidence to support that efficient markets do exist and do work. So what do we mean by efficient markets? Markets that are efficient? What we are talking about is informationally efficient markets. Markets that are informationally efficient. Because when information comes out, as and when information comes out, the prices change according to the new information. So we say prices of these traded assets like shares, bonds, property, derivatives reflect any information that is already known. It is already reflected in the price. And that's what we mean by an informationally efficient market. And we also say not only that prices reflect all available information, but when we get new information, prices reflect it very fast, right? So meaning that people act on that information very fast, and therefore the prices adjust very fast. And based on that information, you can't make profits by utilizing that information in the future, because somebody else has already exploited that information in the past as soon as it came out. So as soon as new information comes out, people analyze it, act on it, and market prices adjust to it. And therefore, you will not be able to act on that information that is already out there and make abnormal returns. So in efficient market hypothesis, one of the things that we talk about, or terminology that we come across, is this concept of abnormal returns versus normal returns. What does that mean? Abnormal returns versus normal returns. What do you think that means?
Returns above the market returns, abnormal.
Above the market return meaning what the ASPI is giving, for example?
Yeah.
Not really, no. Any other explanations?
The returns which will come from like the usual instruments in the market, the range of returns.
Like what, for example?
Say bills, bonds, fixed deposits.
But how do you determine that return?
I was referring to the interest rates usually. It's like it's,
Okay.
Yeah.
So, sorry, inflation you said, is it? . not above the inflation, but it is in the right path. But what we're looking at is, when we say normal is the return that you want to get depending on the risk of the security. So that's normal returns. Normal returns is your expected return. Remember, we spoke about your expected return and your CAPM return is your risk-free rate plus the risk premium, whichever way you define the risk premium. In CAPM, it's beta into RM minus RF, whatever is the risk premium. Your return due to the risk that you're taking, the return that you want is your normal return. Abnormal returns are where you get returns that are in excess of the risk that you're taking. So market efficiency says, anyway, if you invest in a stock and the markets are efficient, you will get your normal returns that justify the risk that you're taking. Nobody's talking about normal returns. But in efficient markets, what people try to do is beat the market, right? What we say is you can't beat the market consistently. Not that you can never beat the market, you cannot beat the market consistently. Because if you beat the market this time, somebody will beat the market. Next time, somebody else will beat the market time after that, and you might also beat the market time after that. But on a consistent basis, you cannot keep on beating the market. And what we mean by beating the market is when we take the fact that we have a fully diversified portfolio. But even if not, what we're looking at is being able to earn returns far in excess of what is justified by the risk that we're taking. And what we say is, if a market is efficient, we can't do that on a consistent basis. We can't make these abnormal profits by trading in and out of shares. What we will make is our normal profit. If I think the share should give me a return of 20%, I will probably make that 20% return as long as the market shares are priced correctly. But I'm not going to be making 25% returns or 40% returns by trading in and out of this stock because of certain methodologies that I've learned, because of technical analysis, because of fundamental analysis, right? I will not be making these abnormal returns. And even if I do once or twice, which is not impossible, because there can be mispriced shares, I will not be able to do it consistently in an efficient market. Questions? Okay. So in efficient market hypothesis, a lot we talk about abnormal returns. Abnormal returns are returns that are in excess of the risk that you're taking, that risk that is justified for the share. And when people invest in shares or invest in portfolios, and what they want to do is beat the market or beat the index, right, and earn a higher return, what we say is you can do it, but you can't do it on a consistent basis. Maybe you can't do it on a consistent basis because the strategies that you use, other people will also exploit it. So you will not be able to keep on earning abnormal returns on a consistent basis and giving additional returns to your investors on a consistent basis. Because efficient market means that any information that is already out there in the market will automatically get reflected in the share price, and therefore you will not be able to consistently beat the market as you go. So when we look at market efficiency, what we say is, if it's an informationally efficient market, you cannot consistently outperform the market by using any information that the market already knows. Okay. You can't consistently outperform the market. When we talk about information, what is information? Information is any news that affects prices that are not known beforehand, okay, and thus appears randomly in the future. It is not news if we say John Keels is now opening the casino. It is simply an opening of the casino that was already there, right? So the project is done, Cinema Life is coming into play, and the day that it opens the project is not news. that will impact the share price, because the day that it opens the project, the future profitability has already been incorporated. The expected future profitability has already been incorporated into the share price. Okay. So in an efficient market, all unexploited profit opportunities will get eliminated. And we say for that, every single person doesn't need to know every single piece of information that is out there in the market. As long as there are enough investors who are there to be able to exploit the new information that comes out, markets will continue to remain efficient. So every single investor in the market does not need to act on information. Markets will remain efficient as long as enough people are there that are acting on new information that is coming out. Shares will remain efficient and markets will remain, therefore, efficient. As long as you have a few people that keep on acting on information, share prices will always be correct. What do you mean by share prices being correct? What do you mean by share prices being correct? Fairly valued. Exactly. Share prices will always be correct means fairly valued. Fairly valued to the new information that is coming out. So here we talk about this concept of optimal forecasts. Optimal forecast. Optimal forecast simply means that we are basing the valuation of the share based on the best available information that is out there. I mean, I can never know, in my example that I have been using now throughout, I don't know once Cinema Live project comes into play, how much profit John Keys is going to make because of the casino project, because of the apartment sales, because of like different things that are happening within that periphery. I don't know exactly how much, but I can make an educated calculation, an educated guess, you might say. I can make an educated forecast. This is what we call an optimal forecast. Based on the available information in the market, I can make a forecast in terms of what, based on the information available, about what type of profitability I can expect because of this operation. And therefore, how much that should impact the share price. And therefore, how much this company is really worth. And share price should then reflect that information. How does the share price reflect that information? Let's say, for example, I mean, right now, what we're saying is all this information is known out there, right? We don't know exactly how much they will make. We can make some educated analysis based on the information that is out there, based on other casinos that are in operation, based on the regional experiences, right? And we can do a calculation to see what is the fair value of John Keys. That's what analysts do, right? That's what you will see a lot of these analysts coming up with different valuations of John Keys. What are they doing? They're making an educated analysis based on the information that is out there. You can't put information that is not out there and make an analysis and say, okay, but if while doing this casino, John Keys also does this, right? Then their profitability will go like this. You can't do that because that's information that is not out there. That's information hypothetically you're building up. But you can make an educated guess based on the information that is out there, right? For example, again, when I take this casino project, you can look at the regional experiences, how much profitability comes from each type of machine that is used, right? So based on that, you can make a best guess in terms of what is the type of profitability you can expect coming in from these, what type of revenues you can expect coming from this, what type of bottom line, cash flows, DCF. Therefore, what is the present value of all these cash flows today? This is what we call an optimal forecast. And based on that, you will have different analysts release information or target prices, say, we think John Keys is worth this much, right? For example, and different analysts will do that, as well as different sophisticated investors, institutional investors, like your different fund managers, for example, will do that analysis on their own, right? And all of these types of investors, whoever the analyst reports go to, some of them will act on that information, and therefore the stock price will already have risen. 1 month later, right, today, after all this has gone into the John Keys stock price has already gone up. You can't suddenly, hearing me talk about it, read a report on John Keys and say, John Keys is worth this much on an efficient market. You will not be able to go and now buy John Keys and get that additional benefit. The first mover advantage is lost. What the benefit you get will be the benefit of John Keys has this much risk, therefore you need to earn at least, let's say, for example, 20% return for investing in this company. So if the market is fairly priced and properly priced, you should be able to make that 20% return. But somebody who had that first mover advantage, who saw this, suddenly when this new news came out and this new analysis was done, this was some time back, right? Who saw this and bought the share because of that new analysis that was done at that time, would have seen a rise in stock price, which would have made them additional returns over and above what was justified. So they overall might be making more than that 20% return that is justified to John Keys, versus you, 1 or 2 or 6 months later, hearing something else or hearing me say this. You can't read in an efficient market, you can't read a report and then go and buy the company and say that, okay, the returns that you're making fantastic returns. 20% return is the return that you're supposed to make for the risk of the company. Just because you make a 20% return, it's not because of the information that came to you. It is the return that is justified for the risk of the company that you're making. If you want to make returns over and above the risk, the justified risk, then you should be acting on you should be acting on new information that's coming out about these companies. Questions?
Just was thinking, man, now when we talk about this new information, like say now when the information is available on public domain, like everyone will see it, right? So the people will act fast and gain these advantages. But what I was thinking is like, isn't there an insider information element always when it comes to this news?
So there shouldn't be. If there is, that is an implication of a lower efficiency of the market, right? If the market is efficient, you shouldn't be able to act on inside information and make abnormal profits, because obviously inside information is inefficient. Sorry, what am I saying? Inside information is illegal. But if you are acting on inside information and you're making that additional profit, that is implying to you that there are certain inefficiencies in the market. Forgetting about the illegality of inside information, if you can do that, that is implying to you a dip in the efficiency of the market. Because when we say markets are fully strong form efficient, you can't even act on inside information and make additional profits, because everybody gets to know that information very fast. That dissemination happens before even the insiders can act on it. That's what we say. That's a strong form market.
For an example about this, your John Keels project, say suppose one of the directors in John Keels knows this is going to happen and he's involved in the discussions, and suppose he's investing through his spouse or someone and act early.
Yes. So that is why you're right. That is why there are, in markets like ours, the safeguards in place are still improving, right? But if you're looking at if you're looking at more developed markets, there are a lot of safeguards in place. It's not that it will never happen. I'm not saying that in developed markets there is no insider information trading. There will be, right? But there are a lot of safeguards in place in terms of like the people who can act on it, and there are monitoring for directors, family members, their accounts. All of these are monitored in terms of trading, especially where there are quiet periods involved, right? And we are going towards that as well. So if you saw, for example, recently SEC issued some directives in terms of how long you can hold materially non-public information, what we call material non-public information. You have to disclose it, right? And if you are trading, for example, when you trade, there used to be a time where insiders in the company, meaning people with key positions in the company, would buy or sell shares, and they would not disclose this as long as possible. Now you have to disclose it within a very short period of time. Still, I think the time is too long. I think it's within 5 days or something you have to make that disclosure. It's still too long, but you have to disclose it within that very short period of time, so that others can also look at what is this, if there is anything there, any particular reason why these trades are happening, right? And they can act on different pieces of information. So this period has to go towards same day dissemination, which it will, but we are still not there, right? Now there are penalties that are enforced, because if you look at it a few years ago, not to find the past, you would see companies, they would do all these projects transactions and they'd wait months before the disclosures came out that these certain material transactions that impact share prices have been done. They'd buy a hotel. You wouldn't know that they purchased this hotel for months. But once you, like, for example, if I'm not talking about John Keats, right? But for example, if you do this type of transaction, you know that this is going to impact your revenue stream. And therefore, it is going to impact your future earnings, right? That's positive information at least. What about negative information? So you should, any material non-public information should be disseminated to the market on an almost immediate basis for public to be able to act on it. And that's where more developed markets are, and that's where we are trying to go. But certainly we have a long way to go to get there. I hope that answers your question.
Yes.
But I mean, we do have inefficiencies. I'm not saying we don't have inefficiencies. Certainly, enforcement is the way to go to be able to really try to control that for the moment.
Thanks, man. Thanks.
So, when we look at, right, efficient market hypothesis, the theory behind it, what we try to say is, we know that when we talk about returns are what? P2 minus P1 plus, if for shares, plus D. This is plus C because it's any cash flows, right? It can be shares, it can be bonds, it can be derivatives, whatever the additional cash flow that you're talking about as a percentage of your initial investment. Now, when we talk about this return, this is a return that we're going to earn over our holding period, right? This is today. P1 is today. I call that P0. This is something that will happen in the future. I call that PT, right? This is something that will happen in the future. So, if I look at this information, I know P0. P0 is the price of the share today. I know dividends because fairly accurately these cash flows, we should be able to understand and know, right? In terms of companies, they have dividend policies. For example, if it's bonds, it's very easy because you know what the coupon is going to be. Most of the time, you will know this external cash flow. You will have a fair idea. What you really don't know is this. What is the price going to be in the future of your holding period, of the period that you're holding this share or bond or whatever, right? So what we say is the price that it's going to be there, this is my expected return. The price that's going to be there is my expected price. It's my expected price. What do you mean by expected price? The price that I expect to be there in the future is actually the price from my best forecast based on the information that is available out there, the optimal forecast, right? The optimal forecast. So I can rewrite this equation to say, this is not just my expected return. This is my best guess of the return that will occur because this is the best forecast of my future price based on the information that is out there. The optimal forecast of the future price because of the information that is out there, right? So either I can say this is my expected return, but what is my expected return? My expected return is the best guess of what the price of this share will be in the future based on the information that is available to me. We call this the optimally forecasted price. And therefore, the optimally forecasted return. These are things that we know. This is today's price. Okay. So this is the only thing that we don't know. The price that will be there in the future. Another thing separately that we say is, anyway, what is the return? Return is actually what we call an equilibrium return, right? It's the return that happens because of demand and supply. It's a return that occurs because of demand and supply. So we put this together and we say, according to efficient market hypothesis, the optimal forecast of my return is actually the return that will occur because of demand and supply. Because of demand and supply. What does that mean? What does that mean? It means that today's prices in a financial market will be set because demand and supply today will be set so that the optimal forecast of the securities return using all the available information equals the securities equilibrium return. Meaning, today's price will reflect the information in such a way that the optimal forecast is achieved. Today's price will change in such a way that the optimal forecast is achieved. Might be a little confusing. We work it out through an example and we'll come back to it. Look at this example. So again, I'm saying today's price will be set in such a way, right? In the share prices will move in such a way today, such that our best guess of the future price will be achieved. Our best guess of the future price will be achieved. So demand and supply will work in such a way today that our best guess of the future price based on the currently available information will be achieved. Because again, remember, what is your expected return? It is the return that justifies the risk that you're taking. But although it is a return that justifies the risk that you're taking, that is based on the forecast of available information. Based on the forecast of all available information to you. The best guess based on the information that's available to you. So keep that in mind. Look at this example. So think of yesterday as Friday and today is Monday or tomorrow. Questions? Second market, let me just check. That's correct. Yeah. Others, questions? Yes, Ravindra, correct. So I have two correct answers. Now, remember, Friday, Monday, there is no difference, right? So yesterday, when the market closed, the price of the share was 90 rupees. Closing price is 90 rupees. If there is no new information available about this share, the opening price should also be very close to 90 rupees. Small differences, but very close to 90 rupees. Okay. Because there's no new information about this share. Technically, there should be small movements if you look at it properly for the return that you're supposed to get, right? But it will be very close to 90 rupees because there's no other reason for if somebody wanted to buy it at 90 rupees on Friday. On Monday, it should open at 90 as well. But now, after the Niraj, yes, correct. After the market closed, the company put out an announcement, right? So, a stock exchange announcement was made. And this stock exchange announcement changed the outlook about the company. It may have changed the return, the equilibrium return that investors want. It may not have, right? But it changed the outlook about the company. And now the expectation is that next year, this price is supposed to be, the market price is supposed to be or should be 120 based on the information that is available. This new information that came up, the price forecast for next year to be 120. That actually might be higher or lower than the original price forecast. No information has been given out because it doesn't say whether this announcement was a good announcement or a bad announcement. So all we know is that there was an announcement made. Maybe it was a positive announcement. The company is acquiring something or doing a new project that's going to give it massive revenues. Or maybe it's a bad announcement. The company's made massive losses or there's been a fire in the factory or something like that. A bad announcement. We don't know. According to this scenario, we don't know. Right? But after doing analysis or upon doing analysis on the company, the analysts say this company is now worth, because of this announcement, 120. So this company's target price is 120. It should go to 120. And based on the riskiness of this company, the return that you want is a 15% return. If we ignore dividends, what are our knowns and what are our unknowns? Return is P2 minus P1 divided by P1, right? Because no dividends. No dividends. So what do we know and what do we not know? P2 or P1? Do we know P2 or P1? Or both?
We know P2.
We know P2. Do we know P1?
The new P1, no.
Exactly. We knew of a P1, but this was in the past, right? This is on Friday. On Monday, what is the price? Or P0 or P1, whatever you call it, that we don't know. We know that next year, we believe this share is worth 120 based on our optimal forecast from the new information that is available. Based on optimal forecast, this price is 120. Therefore, if I want a return of 15% for the risk that I'm taking, today, this stock should be priced at, I saw that you all have got 104.347 or something, right? So 35. 104.35. What does that mean? Because of this new information that came out, so it looks like it's good information. Because of this new information that came out, I believe the stock is worth 120 in the future, meaning it's worth 104 today. Today, to give me a return of 15%, which is for the risk that I'm taking, it's worth 104 today. So today, when the market opens on Monday, when the market opens, it has to open at 104.35. How should it open at 104.35? On Friday, it was moving and it closed at 90, right? Whatever, it closed at 90. Now we're Saturday, Sunday. On Monday, when the market opens, market was closed, right? Should it open when the price opens? How should it look like? Should it start at 90 and then settle at 104.35? Or if the price, should it open somewhere, somewhere above 90 and then move towards 104.35? It will open somewhere between 90 and 104.35 and then move to 104.35? Or should it open at 104.35? What should happen? On Monday morning at 9:30, when the market opens, what should happen? What is the scenario that should occur?
It should open at 104.35.
Yes. At 9:30, if the market is efficient, at 9:30 early morning, the first trade should go at 104.35. It shouldn't open at 90 and then the demand building up and the trades prices move towards 104.35. It shouldn't be that. It should start somewhere between 90 and 104.35. If the market is, these are all inefficient scenarios. If the market is efficient, there is a pre-bidding period before 9:30 when the market opens. Half an hour before the market opens, you can put your orders in. So some people who haven't seen this announcement on Friday might be putting orders in at 90, right? Some people who would have analyzed this announcement on Friday, one second here. Some people who have analyzed this announcement on Friday think that this share is worth 104.35, but is not willing to pay 104.35. They think, okay, we'll try to take advantage of an inefficient market. We'll put bids at maybe 100 or 101 just to try their luck and see, right? And some people who think that this stock is worth 104.35 will put bids in at 104.35, right? And you know it's the best bid that the market will open at the equilibrium price where people are willing to buy versus people are willing to offer. And in an efficient market, at 9:30 itself, it should open at, the first trade should be going at 104.35. So although different people are putting different bids, when you look at the best of a best bid, the first trade should be happening in an efficient market at 104.35. So again, the question on how did you get 104.35 comes from the fact that your return, your equilibrium return, is equals to your return based on your optimal forecast, which is 15%, is equals to P2 minus P1 divided by P1. So P2 is 120 minus P1 divided by P1 is 15%. This P2 is your expected price 1 year, next year, right? Therefore, P1, which is the price today, is 104.35. Questions? Sorry, say that again. Optimal forecast. Yes. Yeah, you're right. So the simplistic argument is that market-wide, the optimal forecast should be the same, which is the basis of a lot of assumptions, right? Most of the assumptions go on homogeneous expectations, where you expect everybody has the same analysis and expectations about the riskiness of the company. That's how CAPM and all that, the base assumptions are. But what we see is, even when we adjust and say that everybody doesn't have the same expectations, it should still come very close to your pricing. Ultimately, remember, with a couple of concepts that we talked about when we spoke about equity valuations. Ultimately, it depends on the person who has the lowest risk expectation, right? That will determine the market price. So definitely, yes, optimal forecast, you are expecting everybody has the same, which will not be the case, but market price will be determined by the person who has that lowest perception of risk. So this example should kind of tell you or help you understand what we say when today's prices in a financial market, today's prices will be set so that the optimal forecast of the securities return, using every single piece of information that's available out there, is equal to the securities equilibrium return. What do you mean by equilibrium return? Demand and supply. There are enough people acting on this security. There is enough demand and enough supply of this security so that there will be people who are putting bids at 90, bids at 91, 100, 102, 104.35, and there are enough bids and offers in the market that the first trade will go at 104.35. Does this really happen in the market? Let's look at it. Right. So this is what we were just talking about. If the market is efficient, when you have good news, oops. When you have good news, you had prices at 90 on Friday, and prices immediately should open at 104 on Monday. Okay. If market is not efficient, so it's immediate. Efficiency means that the reaction should be immediate. But if it is not efficient, you will see that there can be overreactions to good news. Meaning, prices will, now this is really good news, prices will not open at 104, it will actually open somewhere higher at 109, right? And then it will come down. It will adjust back down to the correct pricing. You can have overreaction or overreaction to good news and overreaction to bad news. Okay. When it should open at something that is 100 today, when it should open at 90, or it should be 90, you can have overreaction to bad news. You can also have delayed reaction to good news. Delayed reaction to good news. Where the pricing, I said, might open somewhere between 90 and 104 and then move towards 104. So delayed reactions to good news and delayed reactions to bad news. Both of these, overreaction and delayed reaction, is inefficient. If markets are efficient, prices should reflect all information fast, as soon as possible. Okay? Therefore, delayed reactions are inefficient, overreactions are inefficient. So this is actually Eugene Farmer has done a lot of research, is a person who has done a lot of research in terms of market efficiency. And these are some old examples, but you do see these same types of examples that are there in current markets as well, right? But some old examples that are there from research that has been done in terms of efficient market hypothesis. Let's look at a few examples. Like, for example, when I say old, right? 2001, 2004. Krispy Kreme Donuts, a company that's listed in the US, or that was listed in the US, Krispy Kreme Donuts. So a donut manufacturing company, right? It's a donut chain, big chain in the US. And in 2004, the stock had closed at 11.50 the previous Friday. And analysts thought that this company is going to perform and their EPS was going to be 13 cents for that quarter. Okay, 13 cents for that quarter. But when it opened on Monday, the company announced its first quarterly loss. For the first time since it went public in 2001, it announced a loss of 5 cents a share. 5 cents a share. Right? So analysts were expecting that this company is going to give a return, give a profit or make a profit of 13 cents a share. The company actually on Monday announced, is it on Monday? Earnings announcement due 22nd of November of 2004. What is 22nd of November 2004? So 22nd of November 2004 is Monday. Okay. Earnings announcement was due on Monday prior to the opening of the New York Stock Exchange. So before the stock exchange opened, the announcement came out. And it came out saying that the company has made a 5-cent loss. What do you expect to happen? You expect the share price to fall because the company is not performing the way it is supposed to be performing. It's supposed to be announcing a profit according to all the forecasts that were out there, according to the optimal forecast. We were expecting the company to announce 13 cents earnings per share. Company announced a loss. What happened? Do you see Friday market closing 11.50? Monday market opening 10. There is an immediate adjustment in prices. Immediate adjustment in prices. Okay. So immediate. That's the important thing, right? Remember, a couple of wordings in that you have to keep on thinking about in efficient market hypothesis. Adjustment should be immediate and the news should be unexpected. If the news is expected, it's already reflected. The news should be unexpected. 2004, just near the close of the market, right? Before the close of the market, just before 4 o'clock, Nike announced that Philip Knight, who was the CEO of the company at that time, was stepping down. Okay. Generally, when the market doesn't anticipate the news, usually in companies, especially in developed markets like the US, you would see that big companies like this always have a succession plan. They have a timeline for the CEO to step down, right? So if a CEO unexpectedly announces that they're stepping down, it's not considered good news. That means that something has gone wrong with the company. There has been something bad is happening with the company, which is why the CEO is stepping down, right? Otherwise, there would be a succession plan. There would be a new CEO would already be announced, right? And based on that new CEO being announced, there'll be a timeline of when the old CEO steps down, right? And that happens in Sri Lanka as well to a lesser extent. But you know all of this. Suddenly, if the CEO, there is an announcement that comes in and suddenly it says CEO of this company is stepping down, people start to make all sorts of, I mean, it could be for multiple reasons, right? I'm not sure what this reason was. Maybe fraud, maybe unexpected bad news, right? But something going wrong with the company. But it's not good news. What do you see? Immediately, see, this is not even in days. 10 a.m., 12 p.m., 2 p.m., Nike shares were going along as it were. And suddenly the announcement comes, and immediately what happens to the share price? Adjusts. Immediately, share price adjusts. 2007, the Fed, the central bank of the US, surprised financial markets. We were expecting, or they were expecting, a rate cut. They were expecting a 25 basis point rate cut, but the central bank gave a 50 basis point rate cut. How do you expect a rate cut to impact share markets? How do you expect rate cuts to impact share markets?
Share market would be impacted positively.
Yes, because interest rates coming down would impact share markets positively for several reasons, right? If we look at the dividend discount model, right, your discount rate itself comes down. When your interest rates come down, your risk-free rate comes down. Therefore, your discount rate, your required rate of return comes down. And therefore, your prices move up. So share market, future profitability will move up. You expect dividends to move up because future profitability is expected to improve when interest rates come down. You expect that companies will perform better because now their borrowing costs come down and they have more leeway to make better profitability, right? So dividends can be expected to go up, again, increasing share prices. So Fed funds rate, Fed gave a rate cut, and this rate cut was a 50 basis point rate cut. Market was expecting a rate cut, but they were expecting a 25 basis rate cut. What did you see? Announcement took place at 2:15 p.m. Okay, Eastern Standard Time. 2:15. 2:15. What happened? As soon as the announcement came, the Dow Jones Industrial Average, the index, right? The Dow Jones Index went up. Like the SPI going up, the Dow Jones Index went up. Meaning the shares, the top shares, the 30 shares in the Dow Jones Index were performing better. Prices moved up, right? And that happened immediately. Do you see? 2:15. Announcement came, adjustment happened. So studies that have been done in terms of, for example, takeovers, right? Takeover attempts of target companies. When you look at the abnormal returns, again, abnormal returns, right? Abnormal returns means returns that are over and above the risk that you're looking at, right? That you're taking. On the announcement date, price adjustments have been nearly immediate. With takeovers, you have seen some price adjustments. These are probably leakages in the market, insider trading that you are asking about, right? But still, you will see that there is almost immediate adjustments on the announcement date. So what are you seeing? And these are, although these are older examples, the same examples, because I mean, for me to find a graph that shows you something happening, right? Those are older examples, but the same type of examples you can see today. You can still see. What are we saying? When new information comes out, share markets adjust. Not just share markets, bond markets adjust, derivatives markets adjust, right? When new information comes out, all your securities markets adjust for that information because people act on that information. And that adjustment should happen almost immediately. Almost immediately. And that's what we are seeing with these numbers. The adjustments happening almost immediately. And that's the important thing. And things to understand, the adjustments will happen only if these events are unanticipated. Anticipated events are already priced in. If you have surprises, right? Surprises are what causes adjustments in market prices. Unexpected news, unanticipated events, surprises. These are what causes market adjustments. If it is already anticipated or expected or known, prices will not adjust for that information. Just because yesterday a company published a certain news, right? Let's say, for example, company published their earnings yesterday in the share market, right? While the market was going on, it published the information. And then next day's papers also published the same news. If the market is efficient, you can't read the papers and come and act on that news. Company has done really, really well, or the company has done really, really poorly, unexpectedly poorly or unexpectedly well. You can't read the papers and come and buy the share or sell the share and expect to make a abnormal return, because the price has already been reacted on. And that's important to understand. So this is where we talk about the three forms of efficiency, right? You have weak form efficiency, semi-strong form efficiency, and strong. You all would have heard of these in different subject areas that you've done throughout the course. So weak form efficiency means what? These, I'm sure these you already know of. Weak form efficiency means where prices reflect what type of information. The forms of efficiency are about the types of information that gets reflected in the share price, right? Meaning, does the share price, will the share price get impacted to certain types of information? Does the share price reflect this information already or not? What do you mean by reflecting the information? It means that people have already purchased the share or sold the share, and therefore share price has already moved up or come down because of this information. And in weak form markets, historical information is already reflected in the share price. Just for me to understand, you all have done efficient market hypothesis in some other lecture, right? Probably a little different to the format, but you have done it. And I think weak form, semi-strong form, strong form, anyway, all lectures would refer to it.
Not that I recall, ma'am.
In this course, you haven't done EMH at all, is it? There
was-
used to be international finance or something.
No, they didn't cover that.
Okay. Okay. So it's about how much information, right? So in weak form, what we say is historical prices are reflected in weak form efficiency. And other types of information. So there are three types of information that we talk about. Come to it. Past information, that's historical information. Present information, that's present information means information that's just coming out. That's why I've put it as new and present, right? Unpublished information about today's matters or things that will happen in the future, but unpublished. Past information is already published information. Present information is unpublished information that's just coming out, something to do about the company, maybe about today's position, or maybe about a position about the company in the future. For example, maybe about its current results, or maybe about it acquiring a factory in the future, or something that's going to happen in the future. Okay, that's present information or unpublished information. And then you have inside information. These are the three main types of information that we talk about. And for each of these types of markets, we talk about what type of information is incorporated in the price. What do we mean by incorporated in the price? How much of this information has been acted on? And therefore, the price already reflects it. Price has already gone up. Price has already come down. Past information. So, in a weak form market, we say, in a weak form market, prices reflect historical information. Versus in a semi-strong form market. So, it's about how much price the information is reflected, right? Because we said market efficiency is about informationally efficient markets, right? So how informationally efficient is this market? In a weak form market, prices reflect anyway all historical information, meaning past information about the company. This company has made this much profits in the past. It's made past meaning like last quarter, right? Not this quarter's profit, last quarter's profit. Numbers are out. Numbers are already out. Information is in the public domain. And that information is reflected in a weak form market. Okay. in a semi-strong form market, past information and information that is unpublished, right? It reflects all publicly available information. That is information that is unpublished and just being published, just being announced. How can information that is just being announced be reflected? That is the immediate reflection of information. Okay. So strong form markers reflect all publicly available information. Strong form markers reflect all public and private information. Public and private information, meaning insider information as well. All of this information has been acted on and the prices reflected. So when we talk about these different types of information, you have to understand within all relevant information, private and public, you have the publicly available set and you have the set of past prices, right? Historical information is anyway publicly available. It's historical, it's already done, it's already out there, it's public. What is publicly available and not historical is about the future of the company. It's current information that's just coming out today, just coming out now. Things that you can reasonably deduce about the company that's going to happen. Any new information that's coming out, right? That's publicly available information. From publicly available data, you can reasonably deduce this information. Private information are things that you cannot deduce. That's all information, public and private. Private information are things that you can't imagine, right? You can't deduce that this company A is buying another factory. I mean, I can think of any company. I say, okay, what if they buy that factory? Then what is the profit going to be? Doesn't mean that they are actually buying it, right? I have to have inside information if I know that they're going to buy it, but it's not known by the public. That's inside information. If I know something that's not known by other people in the public domain, that's inside information. That's all information, public and private. So, when you look at these three, can you fill the blanks? What form of information is incorporated in the prices of these markets? Weak form markets, semi-strong form markets, and strong form markets. Can you tick the boxes of what type of information is incorporated in each of these types of markets? Weak form markets, what type of information is incorporated in? $28, yes. Zanila, yes. I'm trying to find the poll. It's not here. Okay. Okay, so I'll call this, I'm setting the poll out. A for past information, B for new information, and C for inside information. What type of information is reflected in weak form markets? So 55, yes, correct. So except for two people who are saying, actually two people are saying that past information is reflected and inside information is reflected. That's not correct. Okay. Past information is the only type of information that is reflected in a weak form market. All the historically how the share prices have moved, historically how this company has performed, like its profitability, all those historic numbers, it's already incorporated in the share price in a weak form market. But inside information is not reflected in the share price. People have not acted on any inside information. Neither is any unpublished or public domain information reflected in the price. What about semi-strong form markets? Semi-strong form markets. What type of information gets reflected in the price? Okay. Here it's multiple choice. You can choose more than one answer. So I have a few people who are saying past information is reflected. That's correct. Okay. Only 85% of people are saying other public information is reflected. That means some people are saying only past information is reflected, right? Actually, both past information and other public information is reflected in a semi-strong form market. And there are two people, again, who are saying inside information is reflected. It is not. It is not. Okay? Inside information is not reflected in a semi-strong form market. In a semi-strong form market. So remember, in a semi-strong form market, only past information, historical information and current information that can be reasonably deduced, but what is publicly available information is reflected in your share price, but not inside information. And finally, strong form markets. What type of information gets incorporated in strong form markets? Multiple choice. So I have one person who's saying that past information is not going to get reflected. That's not right. Past information gets reflected. Current information, all public information gets reflected, and all private information gets reflected in a strong form market. So strong form markets really are a kind of a theoretical market. It's a kind of a theoretical market because what we're saying is, even if it is not known to the market, there will be enough insiders who will act on it, meaning there is no, how would you say, that information will get disseminated almost immediately, right? And therefore, all information will be acted on. Historical, public, and private information, all three types of information will get acted on almost immediately in these types of markets. So, given that, the question is, how can we make money in these types of markets? If we know what type of market it is, can we make money from it? Okay? Meaning, can we earn abnormal returns? Can we earn abnormal returns? Okay. Abnormal returns, not normal. Normal returns, anyway, you should earn. As long as the shares are fairly priced, you should be earning normal returns. Can you earn abnormal returns from these types of market through technical analysis, through fundamental analysis, and through insider trading? What is technical analysis? What is technical analysis?
I'm observing the movement of the stock exchange.
By observing the movement of the prices, right? Yes. Observing, doing analysis on the price movements. That's what we mean by technical analysis. So technical analysis is something like, I'll just jump here for a minute, something like this, where you're looking at the price trends, historical price trends of how the share is performing and trying to figure out how the share will perform. So technical analysis relies a lot on looking at past trends and looking at certain patterns of movement, right? So for example, patterns mean like this. This is one example of a pattern that technical analysts will use, right? They will look at, they have different patterns like this that they use to say these types of things will happen if you see this type of pattern. Okay. So in the past, if your stock price has a head and shoulder pattern, right? A head and shoulder pattern. For example, you have 3 peaks. The second peak is bigger than the first peak and the third peak. So there is a head and a shoulder, right? Head and shoulder movement. If you see these 3 peaks, you look at the baseline, what we call the shoulder line, right? Shoulder line. And if your share price, why is this not shown? If your share price breaches the shoulder line, that is an indication that your share price is going to come down further and you should be selling it. As soon as you see the shares fall below the shoulder line, you should be selling your shares because the share prices are going to crash. That's a pattern that technical analysts use to say, observe the historical share prices, look at where the movements are going, and if you see a head and shoulder pattern forming, so that's 3 peaks, where the second peak is larger than the first 2 peaks, right? If you see a head and shoulder pattern moving, quickly look at your shoulder line and see if after your third peak, if the share price breaks the shoulder line, meaning goes below the shoulder line, it's going to crash. So you should be ready to quickly sell. That's one example of a pattern. It's what we call technical analysis, looking at past trend data of share prices, looking at patterns of movements. You come up with different theories on what will happen to your share price based on different ways the share price is moving, right? So you have, for example, another technical analysis tool that you use is moving averages, right? Moving averages, MA. So here you have the 50-day moving average. What do you mean by the moving average? The last X number of days price, the 5-day moving average, 7-day moving average, 100-day moving average. Here, this is the 50-day moving average. So the last 50 days price. So what do you do? Every day so these are the actual price movements, right? These are the actual share price movements. And you plot on a certain date for the last 50 days share price movements. What's the average of the last 50 days share price movements? You plot that. The next day, you look at the last 50 days share price movements and you plot that. Like this, every day, you look at the last 50 days share price movements and plot it. So this here, now you have a simple moving average line of 50 days of share price movements, right? So this is the last 50 days share price movements. Here you have the last 50 days share price movements, right? And once you plot this moving average line, then these analysts will look at it, technical analysts will look at it, and look at points where the line crosses the share price, right? They look at places where the line crosses the share price chart. Yeah. And here you can see where the line crosses the share price chart. Here, oops. Here and here, there is a clear trend that you can observe because these are very small crossings, actually comes and goes. But here, these 2 points, you can observe a clear pattern where here, do you see this line is above the share price chart and comes below the share price chart. The line, the last 50 days moving average is now below the current share price. It is a buy signal. This is what we call a buy signal, where the line crosses the share price chart, the actual share price chart. It gives you buy signals and sell signals, right? So here you can see this line has come below from before, it has come below the current share prices. This is a buy signal according to technical analysis. And you will have small cuts, but these are not sustainable you can see that it doesn't cross it. But here there is another definitive crossing. Now, from this point onwards, the last 50 days prices are above the current market price. The line has crossed, the current market price has crossed the last 50 days moving average. It is a sell signal. This is the time to sell your shares. Okay. So where your last 50 days moving average starts to fall below current share prices, we say it's a buy signal. And when it crosses to above the current share prices, we say it's a sell signal, right? So you can do this for different moving averages, right? You have, these are some very basic things I'm telling you. Like this, there are so many patterns that technical analysts use to figure out which direction share prices will move. That's called technical analysis. What do you mean by fundamental analysis? So technical analysis is looking at past share price movements, trend analysis, and trying to figure out how shares will perform in the future and try to make an abnormal return. Because why do you want to figure out how shares will perform in the future? Because you want to beat the market, right? You want to make an abnormal return. Otherwise, you don't have to do that analysis. You buy a share that you think is going to do well in terms of like a fundamentally good share, you hold it. If you want to beat the market, you will buy and sell depending on different analysis that you use. What is fundamental analysis? What is fundamental analysis?
Probably doing a sort on a selected share.
Not a SWOT. Get in there. What do you mean by fundamental analysis?
Say, what are their future plans and prospects? How does their balance sheets and income statement looks like? And what is their book value per share? Likewise.
Yes. So that's what you meant by SWOT, right? And then what do you come up with? What's your final outcome of that?
Whether this share is fairly valued or not.
Yes. Right? Your fundamental analysis is where you're trying to look at trying to value the share using DCF valuations or peer valuations or relative valuations or whatever. You're trying to forecast this company's profitability, revenues, cash flows to the future, come up with an analysis of how this company is going to perform, and then look at what is the price worth today, figure out is it overvalued or undervalued. If it's undervalued, you will buy it. If it's overvalued, you will short it, right? And that's what we call fundamental analysis. You're looking at the fundamentals of the company. Based on the fundamentals of the company, you are forecasting information about the company and then look at what is the present value of that information, of that forecast, and trying to figure out, is this company fairly valued, undervalued, or overvalued? If it is undervalued, it generates positive alpha, right? Remember, we spoke about alpha and generates positive alpha, and you will buy it. If it is overvalued, you will short it. That's fundamental analysis. Insider trading is where you act on information others don't know. You find out something about the company. This company has acquired a new venture and other people don't know anything about it yet. So you know, once others get to know about it, the share price is going to go up. So you buy this company. Or this company, there are some labor union strikes, or there are some staff strikes, or there is a fire in the factory or something like that. You know, once others find out, share prices are going to come down. You act on that information before others do. if it is something that is in the public domain that others have not yet caught on to, it is not really insider trading. But here it is something that you are privy to, very few, a very small crowd is privy to because of information that has been distributed only among a small crowd. Then it is insider trading. Like, for example, what I mean is, when I say there's been a fire in the factory and nobody else knows about it, you know about it because you saw the fire and you were passing by and you saw the fire or something like that, right? Then that is not insider trading. You are simply acting on information that will come to the public domain eventually, right? But if the company is not publishing that information, but a very few parties know about it, and for some reason you also know about it and you act on that information, that is insider trading. Okay. So this is essentially what we speak about when we talk about different ways that we can make abnormal profits from the market. So for my poll, let me say technical analysis. If I can, in weak form markets, can I make abnormal profits? Semi-strong form, strong form markets. Okay. I put a D here for my poll's purpose to say none of the above. So for weak form markets, let me relaunch the poll again. 1 second. Okay. Under which form of market can you make abnormal profits? Under weak form of markets, by which method can you make abnormal profits? Through technical analysis, fundamental analysis, insider trading, or none of the above? Still, I haven't got the correct answer. I've got a couple of partial correct answers. Okay. So okay. So let's see. Actually, it's a little tricky, right? Weak form markets are markets where past information is already reflected in the share price. Past information is already reflected in the share price. But this non-published or just to be published or publicly available information is not reflected in the share price. Inside information is not reflected in the share price, right? So in a weak form market, where do you make profits? Can you make profits through insider trading? Yes or no? Can somebody come in, know something that others don't know, trade on that information and make massive profits, abnormally high profits? Yes or no? Yeah, you can, right? So 28 is actually, yes, you can make abnormally high profits by trading on information other people don't know. Why? In this market, in the weak form market, historical prices, like historical information, is incorporated in the prices, but nothing about insider trading, right? What other people don't know is not inside this price. The fact that this company is making massive profits and the sales are phenomenal and making massive profits much higher than expected this quarter is not reflected in the share price. Other people don't know, but you know that because maybe you're a supplier to this company and you're seeing the demand of the raw materials, how fast it's moving. Okay. So other people don't know that. You are seeing it for some other reason. And you're using that information, you're buying the share, it's inside information that very few people are privy to. Okay. And you can, and when share prices actually, when the company publishes their quarterly results and the quarterly results are fantastic, and therefore, after analyzing that, the prices get adjusted in the weak form market because now it's historical, share prices will go up. You can make a killing because share prices are going to really jump when others also get to know about this information. So insider trading will provide you benefits. It's illegal, but it will provide you benefits if you trade on insider information in weak form markets. Fundamental analysis. Can you make abnormal profits or not by trading on fundamental analysis? By in a weak form, yes. Why is that? You're doing your analysis on non-published information and you're making certain assumptions and figuring out will this company do well or not. Yes, absolutely. You can make abnormal profits on fundamental analysis by analyzing the company, how it will do in the future based on certain analysis of how you think interest rates will work in the future, exchange rates will work in the future, macroeconomy will work in the future, demand supply, right? And forecasting things about this company to the future and trying to figure out is this company overvalued or undervalued and buying the company accordingly will give you an edge on other people who have not done this analysis. Because other people who have not done this analysis are people who have purchased this share or not purchased this share based on historical information. You purchasing or not purchasing or selling this share based on this fundamental valuation of whether it is overvalued or undervalued will give you an edge over the others. So fundamental analysis will give you will help you achieve abnormal returns in a market that that only has historical prices incorporated in it. What about technical analysis? Technical analysis. Yes or no? So in a weak form, what are you saying? Yes or no? No. Yes. That's correct. It's no. Technical analysis, we say actually in a weak form market even, you can't make abnormal returns. You can't make abnormal returns by doing technical analysis, right? Remember again, what do you mean by abnormal returns? Nobody is saying you can't make returns. Abnormal returns is the return that you look at after doing all the trading, after taking out all the costs involved in trading. You're looking at, have you beaten the expectation of the risk of this share? And what we say is you can't. You can't beat the expectation of the risk of this share because technical analysis means you're looking at past trends, historical trends, and trying to analyze what will happen to the future. But because historical trends are already incorporated, everybody knows about it, it's already incorporated in the price, you can't make an abnormal gain from it. Actually, technical analysis, we say, you can't make an abnormal gain from technical analysis in any form of market, whether it is weak form, semi-strong form, or strong form. Technical analysis will not give you an edge. That's what EMH says, right? I know now some of you who do technical analysis, right? Or if you believe in technical analysis or have heard of technical analysis, EMH says in any form of market, after you take the trading costs into account, because technical analysis means a lot of trading, right? It means that you're buying shares, selling shares, buying, selling, buying, selling. There's a lot of direct and indirect costs that are involved when you buy, sell, right? Direct costs on brokerage charges, CSC fees, CDS fees, all of those. Indirect costs on buy, sell, the difference between the buy and sell prices, right? The spread. When you take all of these into account, technical analysis will not give you an edge. The word edge is important. It will give you returns, but those returns will not overcompensate you for the risk that you're taking. So that's what EMH proponents have found through their research in terms of technical analysis. What they say is when you take the net trading costs into play, it will not give you an edge. Versus fundamental analysis, if it's in a weak form market, others have not done the analysis. You have done the analysis, identified shares which are either overvalued or undervalued, which will then buying overvalued shares means the share is supposed to give you a 20% return, but because it is undervalued, undervalued, it's giving you a 30% return because you're buying it today, an undervalued share, you're buying it today and you're waiting for the price to correct. And it will give you that additional return because it is undervalued at the moment. So you make an abnormal return. Yeah. Can you make an abnormal return in the semi-strong form market? In a semi-strong form market, can you make an abnormal return from fundamental analysis? You can't. Correct. From fundamental analysis in a semi-strong form market, you can't make an abnormal return. Why? Because everybody else is doing the same thing. Because everybody else is doing the same thing. Everybody else is trying to find the shares that are overvalued, undervalued, and therefore they're doing analysis and they're coming up and buying the shares. If so many people are buying this undervalued share, it won't be undervalued anymore. There is demand. Share price will go up. A few people will make gains. That's why we say use the word consistently, right? Some people will make gains, but all the time you cannot make gains. In a weak form market, all the time, by analyzing overvalued or undervalued shares, you can make gains because nobody else is acting on that information. You are. Very few people are acting on that information. In a semi-strong form market, enough people are acting on that information on the fact that this share is undervalued, that the undervaluation will disappear very fast. And then you will get your normal returns. Share will not be undervalued anymore. Okay. So although there can be anomalies, that anomaly will disappear very fast, and therefore it will not exist enough times for you to make abnormal gains by doing that expensive analysis, because it's expensive, it's time consuming. There is information costs involved. There is your cost of the time that you spend involved, and it won't justify that cost because that undervaluation or overvaluation will disappear very fast in a semi-strong form market. Therefore, you cannot consistently make profits by doing this analysis. Can you make profits by insider trading in a semi-strong form market? Profits are abnormal profits, right? Abnormal returns. Can you make abnormal returns by insider trading in a semi-strong form market? Yes, you can. Because semi-strong form markets, you don't see the prices don't reflect insider information, right? So if you have information that others don't have, you have an edge. And consistently, you can have an edge by utilizing information others don't have. But in a strong form market, other people also have access to that insider information. So they will be acting on it. Okay? And therefore, consistently, you will not be able to make profits on insider information on a strong form market. So abnormal gains are not possible on a consistent basis on strong form markets. In semi-strong form markets, abnormal gains are possible through insider trading. Illegal, but possible. And in weak form markets, fundamental analysis and insider trading are the two ways that you can make abnormal returns, but technical analysis is not expected to give you abnormal returns in any form market. Questions?
A small question based on earlier context that you have described, and not on this this LTCM and Volkswagen short squeeze and all.
Okay.
Now, what I gathered is the understanding of mine is that fundamental analysis would hold true unless you are shorting the market. I mean, in that way, you are avoiding a short squeeze or something. Like when it comes to LTCM case also, if they have not shorted the market, ultimately their analysis would have given them returns, right?
Not necessarily, right? So LTCM or short squeeze or whatever, it's not because you are shorting the market that they made those losses. It was because of margin calls. Because in between, before their theory came true, there was too much of money that they had to put in to hold that they didn't have because they had over leveraged themselves. If they just shorted with like 1 times leverage, they might have still survived. But if you go and leverage yourself 8 times, 10 times, 20 times, then the amount of money that you had to put when something goes wrong is much higher. That was part of the reason though. So it's not the shorting that destroyed them. It was mostly the margin calls.
Yeah, so I'm sorry, like I might have said it incorrectly. Like I mean, fundamental analysis would let me say it this way: like the fundamental analysis would hold true if the particular player has not leveraged the portfolio.
Fundamental analysis can hold through. Yeah. Yes, I agree with what you're saying. I think what you're trying to say is if you're leveraged, then your analysis, you may or may not achieve depending on the in-between factors that come into play.
Yes. Yes. I mean, in the short time, you wouldn't know how the market will behave.
React to it. Exactly.
Yes. And in the long run, it would, the fundamental analysis would give you a return
that you
expected.
Yes, that's correct. So, but then the number of times of the return that you can make from it is curtailed because you are not leveraging. Leveraging amplifies the return as well as amplifying the loss.
Right. Thanks. Thanks.
So we talked about technical analysis and fundamental analysis. Just before we take the break, let me just say this. Right. So when you talk about strong form markets, right? The importance of that strong form market is that what we are saying is if it's strong form, then this market is pretty much a fairly valued market, right? All information, public, private, insider, everything is reflected. People have taken action based on these information, and it's reflected in the price. So the price is fairly valued, right? Because the price is fairly valued, it implies first, so all information is inside that price. So if all information is inside that price, you don't care which security you buy. Or one investment is as good as the other. What does that mean? In a strong form market, all securities are pretty much fairly valued because all information has been incorporated into the price. Therefore, one investment buying John Keys is as good as buying some other investment. Why is that? Because then your analysis is not about companies that are overvalued or undervalued. It is about the risk that you want to take. Are you happy with John Keys risk, or are you happy with commercial bank risk, or are you happy with water plantation risk? Or it's about the risk that you want to take, right? So it's not about whether I'm buying John Keys because John Keys is undervalued, or I'm selling John Keys because it is overvalued. John Keys is correctly valued. So this is the fair price of John Keys. And if John Keys is supposed to give me a 20% return, and I'm happy with that fluctuation, that volatility to achieve that 20% return, I'll buy John Keys. It won't matter to me whether it's John Keys or whatever the plantations or commercial bank or whatever the company, Sunshine Holdings or whatever the company that I'm thinking of. It's about the risk that I am willing to take, that I will be thinking about. It is not whether a company is overvalued, undervalued, because that is not a factor in my decision making. All companies are fairly valued. And thirdly, if the prices are correct, I can use it for my cost of capital calculations. Because sometimes you might have seen this, when you do your cost of capital calculations, your weighted average cost of capital and all that, to come up with these prices, to come up with the cost of equity and the cost of debt, right? Well, to come up with these calculations, we use that market price to figure out what is the return that I expect from the market. But to figure out the return that I expect from the market, John Keys has to be fairly valued for John Keys, right? To figure out the return of commercial bank that I expect from the market, commercial bank has to be fairly valued. Otherwise, I can't use current market prices. But in a strong form market, all shares are fairly valued. Therefore, I can use the security price to come up with what is the proper cost of capital for this company. We can't do that if the shares are not properly valued, if the market is inefficient. So when we talk about efficient markets, ultimately, what do we say? We say efficient market hypothesis is not the full story. There are actually things about efficient market hypothesis that doesn't work in the real world, but it does work in the real world as well, right? You do see there are a lot of evidence that points to the fact that market prices adjust quite fast to information that comes out. So it's a good starting point. So what we'll do when we come back is we'll look at a few favorable evidence, unfavorable evidence before coming to the conclusion on how to look at efficient market hypothesis, right? So we'll look at some evidence that says that markets are actually efficient, and some evidence that opposes it, and then conclude putting it all together. Let's take the break. It's 10:20. 1040 become.